Testing, testing. Okay, should we start? Okay. Ladies and gentlemen, good afternoon. Welcome to Peng Yuan International's Quality webinar. My name is Terry. I'm responsible for the global strategy and business management. Peng Yuan International is a credit rating agency based in Hong Kong, leveraging our 27 years focus on China and a global standard analytics. We use our global ratings and credit research to fill the gap between the Chinese credit and the global market. In recent years, the world has witnessed that the exciting development of electric vehicle globally. China is no exception. But underneath this gathering pace, what should fixed income investor look out for? How are the EV-related companies in China really performing from the quality perspective? And what does bond market, especially green bond, means to the EV-related companies in their green quest? So today, we are pleased to have Ms. Chaoning Huang, the head of Sustainable Capital Market at BNP Paribas, to join our quality webinar. She will be joined by Mr. Danny Chen, our automobile industry specialist of global rating team at Peng Yuan International. So here we have some housekeeping issue before we start. The event is going to last around an hour. We will start by Danny's presentation, which is more focused on the quality side of the EV story, and followed by Chaonings's presentation. After Chaonings's presentation, we will start a dialogue among the panelists and open the floor for questions. So the content in this webinar is not a credit rating action. It also does not constitute a recommendation to buy, sell, or hold financial instruments. So first, let's welcome Danny to start his presentation. Danny, the floor is yours.
Okay, thanks Terry's introduction. So in the following sections, I would mainly talk about the global EV landscape, and China, Europe, and United States are three regions that we would like to focus, put more focuses on. And at the end, I would like to present our view on how the credit profile of some EV-related players in China will evolve when they are going for electrification. So this chart here presents the path of the EV uptake in Europe, United States, and China. So we can see that China has been leading the EV development in the world between 2016 to 2019. However, Europe has surpassed China in Q1 this year, becoming the #1 in terms of the EV penetration. So this is mainly because many EU countries double down on the EV development with increased incentive on EV purchase. On the other side, the US is reeling from the policy setback due to Trump's new rule on the CO2 emission, and that we will discuss later on. We expect the EU to be gaining steam more than China and the US in near terms due to more favorable policy environment in many EU countries. So we want to point out that policy is an indispensable push for EV development that is still in the early stage. So this is the summary of some major countries' EV supporting measures. In a nutshell, these supporting measures can be categorized into three types, which are monetary support on the EV purchases and operations, and infrastructure promotion, and EV strategy and long-term goal that are set by national or local governments. One thing here we want to highlight is that in Europe and the US, the monetary benefit is mainly given to consumers, while in China, this benefit is offered to OEMs. But the way Chinese government do create some issues that we will discuss later on as well. So all of these promotion actions actually are aimed at bringing down the cost of buying and using EV in a bit to boost up the consumption and also the scale of the EV production. So this is China. For China EV developments, we would like to say it's approaching the bottleneck. There are several reasons. Number one, we would say the central government's handouts for passenger EV purchase is subsiding. We can see that the big slash on purchase incentive sparked a significant slowdown on EV sales growth in 2019. So you can see in the charts above, you can see the EV slowdown was about from the growth of 84% in 2018 down to only 1%, which is mainly due to the 64% subsidy cut in 2019. So in fact, the central government started to gradually phase out subsidies since 2017. This is because in 2016, many local EV makers, including some famous names, they overstated their EV sales in order to claim more subsidies from the central government. So this is the force behind the government that they would like to gradually phase out the subsidy, because they don't want their EV makers to lie for the subsidy from central government and have a more healthy development of the EV car in China. So looking ahead, in the next 3 years, from 2020 to 2022, the central government subsidy will keep reducing on a year-over-year basis. The reasons number two is that some key drivers that have reached the limit, causing the slowdown of EV growth. For example, in 2015 to 2016, the EV consumption was mainly supported by the government's purchases of e-buses and some passengers EV for the government-owned usage. In 2017 to 2018, electrification of car sharing and ride-hailing companies such as Didi Chuxing led the growth. However, in 2019, many major cities in China had adopted quite high proportion of e-buses, and for those fleet companies like Didi Chuxing, they were still struggling for profit with insufficient capex to increase the fleet size. So that's why we say the key drivers that we mentioned for China's EV growth that took hold in the past are approaching the bottleneck. The reason number three is that the license plate limits on fuel engine cars imposed in tier 1 cities such as Beijing, Shanghai, Guangzhou, and Shenzhen is another big push, forcing many people to buy EV that are free from these limits in those cities. Having said that, most of these limits have been relaxed in Q2 this year in response to boost auto demand in the wake of the COVID-19. So given a large proportion of EV purchase coming from those 8 cities, these actions of relaxing limits will be a headwind on passenger EV sales in China. But the good sign is that we can see Tesla Model 3, NIO's ES6, these models that focus on high-end markets are gaining market traction in China, especially this year. I would say that this is a good sign because they can raise consumers' attention to those EV products rather than just focusing on the subsidy policy. So I would say this is in the long terms will be we can see a healthy development in the EV cars because focusing on the product rather than the policy side. So for Europe, it's really amazing for Europe this year because we can say that the EV sales in Europe are gathering steam, especially starting from the Q2 last year and outstripping China's EV penetration in Q1 and Q2 this year. Such a strong momentum is mainly attributed to the favorable policy environments for EV in many European countries, together with the acceleration of Tesla model delivery starting from Q2 last year. All in all, we would say the key things is that Europe has been bolstering the magnitudes of the policy support since last year. So when it comes to the outlook of EV uptake in Europe, we would say it's relatively strong momentum is expected to continue in near term. For the supply side, many giant auto OEMs in Europe like Volkswagen, BMW, Daimler, Renault are scrambling to introduce more and more EV products in their lineups in a bid to meet the increasingly stringent standard on CO2 emissions by 2030. If they cannot fulfill the new rule by the time set by the European Commission, auto OEMs have to face a hefty amount of fine. So this line charts shown here demonstrate that the new CO2 emissions requirement by 2030 is a bigger reductions from 2021 level than the old one. So we can see by 2030, the new ones, the CO2 emission is 59 gram per kilometers. However, the old one is 67. So the reduction is more serious than the old one, which is a strong push for the OEMs to introduce more EV. From the demand side, we would say many European countries take active steps in promoting adoption of electric cars, and the possible VAT cut for EV purchase that has been negotiating amongst European Commission will be another strong push against EV purchase if these actions take place eventually. Our research publication on this issue point out that the VAT cut will be a big tailwind to the EV adoption amongst European countries. So we can see these slides. We show the table that summarize the national level and the city level promotions together with EV adoption strategy and targets taken by major European metropolitan cities. We conclude that, generally speaking, the more promotion actions on EV purchases and operation, the higher penetration rate that we can see. So that's why we would say that in the early stage of the EV development, policy matters the most. Okay, we come to US. US, we would say it seems to be a lagger compared with China and Europe in EV development. US EV sales, as this chart show, saw a rapid takeoff in 2015 to 2018 due to the surge of Tesla, which is the key drive behind the growth of US EV sales. However, the EV sales lost steam since 2018 as Tesla and GM, the two largest EV players in the US market, both reached the cap for enjoying full federal tax credit in 2018. Let's look at Tesla. Although it delivered 50% more cars in 2019 than in 2018, the delivery for the US market alone only saw almost no growth. We can see in 2019 it's just 0.3% growth only for the US market. So why? Again, we will say the policy is one of the major stirring force behind. So we can see that other than the purchase incentive given by the state governments, the federal government also offer EV purchase incentive of $7,500. So, but this amount will start to be halved by every half years once the cap of 200,000 electric cars sold by the OEMs has been reached. For example, Tesla reached this cap in late 2018, and given this future path that the charts show here, you can see that the consumer that buy Tesla model since 2019 will receive less and less federal government's monetary support, and eventually no more support in 2020. So therefore, this is a large part that can explain the sudden break of EV sales growth of Tesla and also the United States. So we'll throw a question that whether this cap set at 200K is too low, because we can see that 200,000 is still far away for auto OEMs to reach the break-even scale. So this is one of the questions that we would consider. Okay, so on the supply side, we would say the new CO2 emission passed by Donald Trump reversed the President Obama's course. Well, I would say that we can see in President Obama time, he reached an agreement with 13 big auto OEMs in 2011 to increase the fuel economy, targeting to reduce greenhouse gases emissions by 5% per year from 2020 to 2025. So that's we can see the line chart here. But however, in the President Donald Trump era, he rolled back the rule. He rolled back the rule with the new one announced in early 2020 that will relax the reduction of this kind of greenhouse gases emissions to just only 1.5% reductions per year from 2020 to 2026. So compared with the Obama's one, this one is lenient, which means that Donald Trump gave more flexibilities to OEM to still stick on the old fuel economy. So this policy is like a disincentivize US auto OEMs uptake of electrification, because the policy push now becomes less urgent than it was. And that may put US auto OEM in a disadvantageous position if they really slow down their technological improvement over fuel economy and also the fuel efficiency due to this loosened policy. So, but we would say from the state perspective, because as we all know, United States have a lot of different state, and those different states have different policy. So we can see the supporting measures taken by various states are very uneven. For example, in California, where many tech companies headquarter and many tech professional work, and also thanks to the very friendly environment to EV, we can see that those cities in California enjoy greater EV penetration than those cities with less promotion action, such as Pittsburgh, Houston, that are famous for manufacturing of traditional cars. So with this uneven policy landscape among various states in the United States, it seems that the federal government subsidy looks very necessary to mitigate this imbalance. However, as Tesla and GM both have reached the cap, buyers for those two OEMs model cannot enjoy the full subsidy. In our view, this is very instrumental to the EV prevalence in the US. So this is some of Pengyun's thoughts on the EV development. To conclude, we'll say supporting measures still play a big role in promoting more adoption of EV, as the cost of EV is still higher than the inner combustion engine cars. In addition, we suggest that governments need to stick to the long-term goals and the execution path once having them in place, rather than changing over the time. This is because by doing so, automakers can have a better plant formulations from the long-term perspective, rather than just following the short-term policy. Additionally, this a staggering R&D expenditure is inevitable. As the call for the cheaper battery is very urgent. Nowadays, there are many new technologies and business models that are under development to drive down the battery cost. One thing we want to point out here is the battery swap model proposed by NIO, one of the newcomers in China. This new business model helps reduce the EV price by separating the ownership of the car and the battery. EV buyers only lease the battery instead. We think this new model can have a better and more efficient management on batteries in terms of charging them fast and disposing them safely. In this regards, this model looks good fits to those fleet companies that are highly time sensitive. And also, this model is currently promoted by Chinese central government and quite a lot of local government as well. And it might be able to pave the way to let us see so-called battery bank in the future. We expect the battery pack cost to dwindle to around $100 per kilowatts by 2023 to 2025, which is a cost parity level for EV against the ICE cars, without additional government support. Okay, so we comes to the credit profile. We will say that we look at the credit profile. We select some sample companies from auto OEMs and also the battery components and also battery cells makers. So for this slide here, present some of our findings on the creditworthiness of China auto OEMs. So the sample here includes some big names like Geely, BYD, and Great Wall, etc. The conclusion is that we anticipate a strain on the creditworthiness to continue in near terms due to the increased competition and weaker demand after COVID-19 that would harm the EBITDA margin and the ability to serve the debt. In our view, the capex this automaker spends in next 2 to 3 years is projected to remain high, and it is mainly financed by debt as the interest environments could remain ultra low in next at least for a longer period. So with this increasing capex and weaker profitability, ROIC for this auto OEM is likely to see the continuous pressure. However, on the other side, for the sample China battery cell and components makers, we would say they both can benefit from this increasing spending of automakers in the era of electric cars. But we would say battery makers like CATL, Eve Energy, this relatively large-scale player can benefit more. The logic here is that battery cell makers play a crucial role in leading the EV development, thus having strong say in the supply chains that can ward off the margin erosion. On the other hand, given the weaker position in the battery supply chain, the battery component makers could face some headwind on their profit margins under the backdrop of battery cell makers having strong it on the cost control. We will say over the next 3 to 5 years, both of battery cell and component makers could raise more debt to fund their growth in order to follow the trend of electrification adopted by many OEMs, either locally or globally. So net, with more debt plus some uncertainties on profitability, the credit profile for battery cell and component makers could see a great challenge ahead. But the bigger players should have a better credit position in the long run. And at last, This is the chart that summarizes our brief views that mentioned previously. And for more detailed explanations, I think audience here can spend some time on our research publication discussing this issue. And this is the end of my presentation. So I would pass to Terry, and yeah, thank you everyone.
Thank you, Danny. So now let me turn the camera to Chao-Ni. Chao-Ni, please bring us some perspective on green finance and where exactly the rubber meets the road. Thank you.
Great, thank you very much, Terry, and thanks to Pengyuan for having me on your webinar. Good afternoon and good morning, depending where you are for those who joined the webinar. So I'm Chao-Ni, I'm Head of Sustainable Capital Markets for BNP in Asia Pacific. So before I deep dive into the EV aspect, I'd like to also give you an overall of the green finance or sustainable finance market, in 2020 year to date. So as you can see, it is a fast evolution when it comes to sustainable debt capital markets, from the first green bond in 2007 to, $1 trillion outstanding market today. So I think, it's fair to say the growth is exponential. So for 2020, total issuance year to date is at USD 236 billion compared to same time last year at 167 billion. So the growth rate is about 41% year on year. And very interesting, in the mix of sustainable bonds, you are seeing increasingly more and more colors, more and more labels, from green bonds to social bonds to sustainability bonds, sustainability linked bonds, transition bonds. And yesterday we even priced, a blue bond, which is an ocean related, green bond in the market. So it's getting increasingly more diversified in terms of labels, which means, capitals are being allocated to a variety of sustainable projects, from climate change adaptation to broadly environmental protection, such as, ocean, as well as, social aspect, such as, under the implication of COVID-19 on society as a whole. So if we could go to the next page, we also summarize, the kind of issuers, in the APAC market for investors who are on the call, issuers on the call who want to understand, what type of issuers are leveraging, this label to issue. So we look at, 2019 to 2020 first half of transactions. You can see that, the majority of the issuers are driven by financial institutions and corporates in Asia Pacific. Certainly when it comes to currency, USD has become a natural choice in the offshore market. And investment grade issuers remain the cornerstone of the market, but high yields issuers are increasingly active, in the last, 2 years or so. In terms of country mix, you can see in the big donut here that China and South Korea have been dominating the Asia sustainable bond markets, excluding the onshore issuance. So a lot of Chinese and Korean issuers are taking advantage of strong demand for sustainable bonds and use this label to establish, their green bond framework or sustainable bond framework, and articulate, their sustainability strategy to raise capital. And they have been doing tremendously well in the last few years, and so they become very regular in the sustainable bond markets these days. If you go to the next page, we also took the opportunity to summarize, the performance of sustainable bonds, because I really get these questions a lot from issuers to investors: how sustainable bonds, green, social, perform compared to conventional issuance. So we look at new issuance premium from across credit ratings from 2019 to 2020 first half. You can see that across the board, regardless of rating, we actually do see sustainable bonds are able to achieve better or achieve lower net new issue premium compared to a conventional underlyings. The difference is more significant. Across the board, the difference is about 5.35 basis points in terms of outperformance between these two labels. So investment grade, the outperformance is about 3.9 basis points in relative to conventional bonds. And price comparison, which is on the next page. In terms of price comparison, we actually look at, during execution, sustainable bonds and conventional bonds, how do they do from initial price guidance to final pricing guidance? And overall, we actually see sustainable bonds consistently outperform conventional bonds in terms of pricing compression. Although the difference is not significant, we're talking about a few basis points, between the two asset classes, but still you can see there's a bit of benefit, that issuers can enjoy if they can establish a robust sustainable bond frameworks and can articulate their sustainability strategy well in front of investors. And we talk about new issue premium, pricing compression, and many of you already heard that subscription is also very strong when it comes to sustainable bonds, a lot higher than conventional if you have something like that in the market. And all of that we think is attributed to very strong demand, or in fact it's a demand over supply environment that investors, particularly investors with ESG integration approach, include embedding environment, social and governance in consideration into their investment strategy, will pay particular attention on these sort of labeled sustainable instruments in the market. One is to fulfill their mandates required by asset owners. At the same time, they also have the conviction that sustainable bonds or issuer who can issue sustainable bonds have a stronger quality in terms of management, in terms of vision. Therefore, they would like to invest in these sort of names and instruments from the market. So over the years, very strong demand, and we actually do expect demand will continue to be strengthened. Traditionally, it's a very much a European investor-driven environment, but increasingly we are also seeing supportive policies as well as investors organically evolved vision in terms of ESG integration. So demand is going to get stronger and stronger. Which is good news, to the issuers who have been issuing, sustainable bonds very regularly, as well as potential issuer who want to leverage, this strong market dynamic. So that's about the sustainable bond market, at a very few minutes summary. So how is it relevant to the EV market? Danny talked a lot about the growth of the electric vehicles in various markets, coupled with climate policies. So I'd like to dive into it a little bit with you in terms of the contribution to the environmental agenda and how the green bond market has been supporting the development and deployment of electrification of vehicles. So from this slide here, you can actually see electric vehicles being a very important technologies to reduce air pollutions, in high density areas, as well as a main contributor to energy diversification and climate greenhouse gas reduction objectives. And in fact, the climate and environmental objectives are the main drivers behind favorable policy support and in the electrification, evolution. So today, there are about 17 countries have publicly announced either 100% zero emission vehicles or phase out of ICE conventional vehicles throughout 2050. France in December 2019 is actually the first country that actually turned this intention into a law. Close to home in China, China aims to increase the share of new energy vehicles, which is electric vehicles, from a very low base of 5% in 2019 to 25% in the next 5 years. So, the climate objective is very clear. The electric vehicle objective is also very clear from a top-down policy perspective. So therefore, it also support the conviction that the market will continue to grow. So in terms of carbon reduction, the chart here is actually quite clear. You can actually see that if we just look at 2019, 1 year alone, electric vehicles in operation, globally speaking, avoided the consumption of almost 0.6 million barrels of oil products per day. And if you think about, actually some people would argue, well, but for electric vehicle, I still have to charge, my cars, and the electricity actually comes from the grid that can be mainly come from, fossil fuel-based energy. But even taking that into account, electricity on average required to supply EV on the roads is still emitting half of the emission that could have been emitted, by the equivalent amount of fleet from ICE engines. So this corresponding to 53 million tons of carbon equivalent of avoided emissions. So the potential is extremely significant as we roll out more EVs on the road. Can you turn to the next page, please? And very often, from the environmental perspective, we talk about the upstream, which is the grid, the reduction, climate reduction potential would be very significant if we can couple electric vehicle with low carbon energy, and which is something that we are seeing, around the world with the roll out of expansion of renewable energy. So as the grid become decarbonized, the EV itself will actually lead into more carbon reduction. But what about the end life? In Danny's presentation, he talked about batteries being an extremely important components. Similarly, when it comes to the environment is concerned, the life cycle of EVs becomes extremely important. And there are a lot of research, including the one that we use here in the slide from International Energy Agency, that's actually pointed out that assuming global average GHG intensity of electricity, all type of EVs still have a lower life GHG emission compared to internal combustion engine vehicles. And going back to battery in particular, and I think this is where there could be, or where investors are particularly interested in how electric vehicle manufacturers, component manufacturers are dealing with when it comes to the end life of batteries. And it's because batteries is responsible for up to 1/3 of the EV's life cycle GHG emissions. And we actually propose certain key aspects, for auto companies who are on the call or analysts who are particularly interested in the end life treatment of vehicles, of batteries. First of all, certainly is to increase the energy density of batteries and increase energy efficiency and use low carbon energy sources in the whole value chain, from the very upstream of mining, refinery, and synthesis of raw materials in the production, manufacturing, and packing of the batteries. And finally, is the end life treatment of the batteries. Issuer need to really make sure that they have appropriate end life battery management process that can channel the spent batteries to second use, recycling with the aid of policies to support them. Earlier, Danny mentioned, NEO's approach of battery leasing, which is also an innovative way of better treatment, of battery to make sure it doesn't, go into the waste stream to pollute, our environment in the end life. Can you go to the next page, please? Sorry, I don't have the turn function. So is the green market or green financing market living up to its expectation, given that we talk so much about the carbon reduction potential from the electric vehicle throughout the life cycle? And is green bonds really doing their job to support or to finance EVs or clean transportation, broadly speaking? Well, the quick answer is yes, it does. As you can see, green bonds channel towards clean transportation has grown almost ninefold, from 2015 $6 billion issuance to about 53 billion in the end of 2019. And if you go to the next page for 2020 more updated figure, you can see that for 2020 year to date, about 28% of green bonds globally issued are directed to clean transportation sector, which is the second largest use of proceeds by volume, followed by renewable energy. So you can see that clean transportation, including EV, including mass public transportation such as electric powertrains, have been a very popular destination in terms of use of proceeds. In fact, just in Q3 this year, we have seen 2 green bonds issued by China Construction Bank, China Merchants Bank, have dedicated their net proceeds from the green bond issue to low carbon transportation projects. So it has become a very distinct, share of the green bond space. Next page, please. So speaking of China, no surprise, China has been a very consistent global leader in the green bond space. In 2019, China's green bonds represent 20% of the global supply, and finance for transport in China also grown, continuously, growing 11% from USD $10.1 billion in 2018 to 11 billion in 2019. And in fact, transport is the only category that have increased every year since the very beginning, since the inception of the green bond market. So whether you measure by international green bond standard or domestic China green bond standard, you can see very clearly that clean transportation, including electric vehicles, have been a key segment in terms of deployment of green financing to these areas. Next page, please. So towards the end, I also want to really show you auto companies who have been active in leveraging the green finance market to issue green bonds. The most recent one would be Daimler, which just issued last week with their green bond. So these have the deal was traded very well, strong oversubscription in the book, And so it's actually a good reference for you to see, or for investor and issuer to see who has been issued and how active these issuers are in the space. That's it for my presentation. Happy to take questions in the during the Q&A.
Thank you, Chao-Ni. Thank you, Danny, for the excellent presentation. So now we enter into dialogue section. So the first question is, let me go to Danny first. Hi, Danny. In your desktop analysis, we understand that the EV OEMs in China are currently under quite some pressure from credit-wise. But is there a light at the end of the tunnel for them? And if yes, where should we look for them?
Okay, thanks, Terry's questions. I would say in a very long term, we can see the light in the sense that those OEMs who spend a lot of time in the EV, they will have a better position and more attractive products in the market, because maybe at that time the markets would all goes to the EV. But I would say it's very long term. But in next maybe 3 to 5 years, we will still say those auto OEMs, they will still suffer from the increased capex in, for example, in EV, in autonomous driving, in quite a lot of frontier technologies that would give a high burden on their credit profiles. And at the same time, we would say the auto demand would be continues to be very not very, maybe quite weak, especially after the COVID-19, because we will see the demand for this discretionary consumption goods would be taken a heavy toll by these COVID-19 crisis. So I would say the life is not easy, at least in the 3 to 5 years for auto OEMs.
Thank you, Danny. And also for the presentation. On the other hand, it seems like you're relatively more positive about the EV parts manufacturers in China. And we all know that you have done a pretty detailed analysis for CATL before in your research report. Well, CATL is a battery global frontrunner. Would you see this positive dynamic for EV component maker to sustain in the foreseeable future?
Okay, I would say this positive dynamics could sustain at least in the next 3 to 5 years. The logic is that because at this point of time, we can see a lot of OEM, they spend a lot of capex in EV related industries like battery. And so that's why we can see battery cell makers and also the battery components makers, they can benefit from this higher capex from auto OEMs, which says they can have a rising amount of orders. So on the revenue side, we would say they can benefit from this order that cause increasing scale. But on the profitability front, we say they still have to face some pressure. For example, the battery cell makers, they will see the pressures from OEMs to lower the battery price, and battery components makers will see the pressures from the battery cell makers that ask for a lower price. So the profits may take some pressures, but I would say net, I would see it more positive on the battery related makers like battery cell and battery components. So I would say the life is like better than the OEMs, at least at the last 3 to 5 years.
Thank you, Danny. Let me turn the question to Chao-Ni. Well, this is about the external environment. We all know that for the current external environment poses a lot of challenges for Chinese issuers in the global market. So do you actually see the Chinese EV companies or EV related companies can still benefit from issuing green bond in the current environment? Or is there anything that they should be particularly careful about when they do so?
Very good and big question. Certainly, we are facing a lot of negative headlines throughout 2020. From COVID, to U.S.-China tension, so on and so forth. So, but the global market, primary market is still very active. Looking at the recent transactions these days. My answer would be, I think it's still beneficial. It still has a lot of value add for Chinese auto companies to go to the capital market with the green bond, with the green label. If this is, if they are working around the capital raising strategy, green would certainly add more favorable points to them, in the sense that, like I mentioned earlier, it's a demand over supply environment. Investors are particularly interested, in green bonds, in sustainable bonds. So it's a way for them to differentiate themselves in the capital market in front of international investors. And secondly, as a lot of Chinese auto companies are also adopting an export models, I think we should also look beyond, the cost of capital, investor diversification to their international expansion strategy. A green bond will become a very effective tool for them to communicate, their vision when it comes to climate change, as well as, their operation performance in terms of environmental protection. So this would be actually very strong benefits, for them to issue, leveraging, the favorable push, from the green bond market. And I think, if that's something that the Chinese auto companies are pursuing, certainly it's very important to keep in mind how robust the framework, the green financing framework needs to be, and the overall sustainability strategy, because we see very often that their issuers would only go to the green bond market with the green halo objective, which is not something that investors want to reward. So there will be so issuers should really think about, do I have the capability to develop a strong management approach to manage the green bonds once I issue it, because there will be ongoing reporting requirement. But we actually think this will strengthen a lot of internal management system as well, with the integration of sustainability.
Thank you, Johnny. And also from your earlier presentation, we understand most of the green issuers are actually in the investment grade space. So could you share with us about your interpretation of this situation? Because as you know, a lot of EV companies, well, especially the car parts companies in China, a lot of them was still in the high yield space. Do they still have a chance? Any advice you can give them?
Absolutely. Even though if you look at the current green bond market, sustainable bond market globally, it's very much dominated by investment grade, issuers across issue types. But it doesn't mean there's no opportunity for high yield issuers. And in fact, we are, we're actually seeing, high yield issuers popping up in the green bond market, in the recent 2 years. From real estate sectors, including high yield names, as well as unrated names. So many of them have enjoyed the success of from issuing with the green label. So I would certainly encourage high yield issuer to also explore this, because this is the market where demand is oversupplied. It's very important to identify what investors are looking for right now in a very volatile environment. So sustainability or green can become a very important value proposition for you to attract high quality investors. And similarly, from an investor's perspective, as they have been invested in a lot of investment grade, bonds, they are also seeking yield. And right now, it's a very low yield environment, and in Europe, it's a negative yield environment, right? So if there are quality high yield issuers with strong ESG credentials, it's actually becoming something that they are particularly keen to look at. So I think investors certainly would be very attracted, if high yield issuers are tempting, the green space.
Thank you, Tony. Well, due to the constraint of time, let me take one last question from the floor. Well, for those global investors that wants to invest into the EV-related green bonds for Chinese credits, is there any tip from either Tony or Danny? So feel absolutely free to comment on this question from both credit and green perspective.
Okay, I take this question first. I would say, for example, from the EV battery makers or components makers, I would say they still needs to increase the capex in order to follow the electrification adoption by the OEM. And I would say in such a low interest environment, they would prefer debt rather than equities. So I think as we can see, like CATL, they issue offshore bonds, and then I would say maybe some other companies that the scale is smaller than CATL, but they still have the plans to cater the overseas OEM. Maybe in the future they will issue offshore bonds. So I would say we will see the trend that these EV-related players, they would be active in the bond market. So maybe Charlie can give more colors on how they can benefit from like using the green bonds ways to raise the funds.
I think for investors who are looking into green bonds from EV companies or related companies, I would say from the green aspect, investors would be particularly interested not only the use of proceeds, because it's very clear in terms of capex expansion, in terms of equipment, so on and so forth, into EV as well as R&D. So these are critical components in terms of use of proceeds, which is very straightforward. And I think investors would also look beyond the use of proceeds in terms of how strong the companies are in taking the environment into account, from the way they operate, right? The manufacturing itself can be a very environmental intensive, activity. So even though you're producing a green product, it does not necessarily mean the operation is green itself, right? So there will be a lot of concerns on air pollution, material sourcing, materials use, as well as discharge of waste and water, so on and so forth. So I think investors would look beyond the use of proceeds to look at the operational aspect of the companies, as well as end life treatment of the EV products, from the vehicle themselves all the way to the batteries, which we talked about earlier. So there could be actually a lot of interesting aspect to structure a robust green bond for EV companies, and I'm sure in ESG investors, particularly those who are very sophisticated in analyzing green bonds, would grill issuers on these aspects.
Thank you for both very much. I think we have come to the end of this webinar session. So for the audience, if you have any future question about EV credit and the green finance, you're most welcome to contact Danny or Tony. And we look forward to meeting you in the future events. You have a great day. Bye-bye.
Thank you.
Thanks.